Welcome back to Investing Talk Podcast.
Today we're looking at CRDO Technology Group.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. We've got a set of sources here that really paint a picture of a company hitting a major inflection point.
An inflection point. Okay, so let's unpack that, starting with these pretty stunning top-line figures.
They're incredible.
The sources show trailing 12 months revenue was already strong, right? Hitting $600.14 million.
Right, which is solid on its own, but that's not the real story.
That's just the steady state. The story is in the recent acceleration.
Exactly. We really can't talk about CRDO without zeroing in on their Q3 fiscal 2025 results. I mean, revenue didn't just grow.
No, it surged.
It surged an astonishing 273.6% year over year. They posted $223.07 million.
And the consensus forecast was what, around 190?
Yeah, $190.63 million. So they just blew past it. That is an enormous material beat.
A beat of that size, it suggests something more than just, a good market. It implies they're taking serious market share.
Or their tech is being adopted by multiple huge customers all at once.
What I really like to see, though, is that this wasn't just growth for growth's sake. It wasn't just, raw cash-burning growth.
No, not at all. The profitability metrics are, frankly, just as impressive. It suggests really disciplined management.
Okay, so what are we looking at there?
Trailing 12 months net income was $125.12 million. That gives you a net margin near 20.85%.
Which is very, very good for a semiconductor company in a massive expansion phase.
It's impressive, and it shows up in their capital efficiency, too.
You're talking about the return on equity.
Yep. The ROE figure is a robust 19.02%. In this industry, that kind of return tells you their R&D spend is translating directly into highly profitable products.
It places them right near the top of their peer group.
And that's exactly why the sell-side analysts are so optimistic. They don't see this as a one-off.
They see it as a sustained trend.
Exactly. They expect strong EPS improvement well into fiscal 2026. The market believes this is the real deal.
Which brings us to the core question. Why? What is their competitive moat? How are they doing this?
The moat is all about their specialization in high-speed connectivity. They make the ICs, the IP, the active cables, everything for next-gen data centers.
So they're focused on moving huge amounts of data fast and efficiently.
That's their entire game.
We often hear all this jargon, CRDO, PM4, DSPs. Can you break that down a bit? Why is their proprietary SerDes tech considered best in class?
Absolutely. So think of SerDes. That's the serializer, deserializer is the bridge.
A bridge for data.
Exactly. It takes high-speed parallel data, turns it into serial data to travel a long distance, and then turns it back. CRDO just makes these bridges that use way less power at incredibly high speeds.
Like 400G, 800G.
Right. And PM4 is the signaling trick that deepens the data rate over the same wire. And their DSPs, the digital signal processors, they just clean up the signal.
So in a data center where power is a huge cost,
if CRDO can move data faster using less electricity, they become the go-to supplier for every hyperscaler out there.
okay, so that explains their core business. But the real shift, the thing that seems to have changed the valuation, is the AI narrative.
That's the critical aha moment for investors, you're right. In November, CRDO announced something very, very specific that tied them directly to the AI boom.
The industry's first memory fan-out gearbox.
That's the one.
What does that actually do? Why is a gearbox so vital for AI?
Well, when you're running these huge AI models, like for inference, the bottleneck isn't always the main GPU.
It's getting the data to the chip.
It's getting data in and out of the high-speed memory that's attached to the chip. This fan-out gearbox manages that connection. It optimizes the bandwidth between the accelerator and the memory.
So by having the first one,
They're planting a flag in a super specialized, extremely high-growth niche that solves a fundamental problem in AI computing.
so they go from being like essential plumbing for the cloud to being essential plumbing for the most expensive part of the cloud, the AI cluster.
And that is a huge expansion of their addressable market. It directly connects their tech to those financial results we just talked about.
Which requires constant reinvestment in R&D, I assume.
Of course. And their balance sheet is strong. Low debt, plenty of cash. It allows them to stay ahead of the curve.
Okay, let's pivot from the fundamentals to the technicals, because the stock has just been on an incredible run.
The technical picture is, to put it Mildly, unequivocally bullish.
It's trading way above its moving averages.
Way above. The 50 days around $152, the 200-day is much lower, maybe $90 to $110, and the current price is $170.16.
That shows powerful, sustained momentum.
It really does.
But we have to talk about the scale of this rally. The shares gained 284% year over year. The whole tech sector benchmark was up, what, 33%?
Yeah, 33.5%.
So with a 284% run already done, aren't we just chasing momentum? Is all the good news already priced in?
That is the perfect question to ask, and it leads us to this really fascinating detail in the sources, the analyst disconnect.
The disconnect.
Yeah, so the consensus rating from 13 analysts is a strong buy, but the average price target is only $133.67.
Wait, that's way below the current price. How does that make sense? A strong buy rating with a target suggesting the price should fall.
It means the market has moved much, much faster than the big research departments can update their models. That average is being dragged down by old estimates from before this big AI pivot.
Ah, so you have to look at the recent updates.
You have to look at the trend. Firms like Susquehanna, Barclays, their new targets are already up in the $165 to $175 range. The market is pricing off that, while the consensus average is still playing catch-up.
Got it. So you follow the fresh money, the fresh analysis, and retail sentiment is following suit too.
Exactly. But let's look forward. What are the upcoming catalysts that could drive this even higher?
The most immediate one is the Q4 2025 earnings release. That's on December 11th.
And given their track record of upside surprises, especially with this new AI product starting to ramp, that could be a huge day.
And then right after that, we get Q3 fiscal 2026 guidance on February 13th.
And guidance is always more important than the past quarter. If management signals that AI spending is still strong, that validates the whole thesis for another year.
Then you have the more market structure stuff.
Right. ETF rebalancing on December 20th, that could mean forced buying from passive funds.
And then the institutional 13F filings on January 23rd, if we see some big funds piled in last quarter.
That could ignite a whole new wave of buying.
We also can't ignore the more speculative side of things.
So you mean M&A chatter?
Exactly. With such specialized AI-specific IP, the kind that's really hard for big players to just build from scratch.
There's always talk that a larger chip maker might just decide to buy them to get that tech quickly.
And then you have CES 2026 in January, a perfect stage to show off new products and excite the market.
Okay, this all sounds incredibly bullish. So now we have to do our job and provide the balance. What are the risks? What could go wrong?
There are two big ones to watch. First is customer concentration.
Their success is tied to a very small number of very large customers.
Your North American and Asian hyperscalers. If just one or two of those companies decide to cut back on spending.
Or worse, pivot to an in-house solution, it would hit CRDO very hard, very fast.
And the second risk, and maybe the bigger one right now, is just pure volatility.
The beta. The sources have it at 2.62, which is high.
Can you explain what a 2.62 beta means for someone listening?
Sure. It means that if the broader tech market, say the Nasdaq Q, drops by 1%, CRDO's stock is likely to drop by 2.62%.
So it moves with more force than the market, in both directions.
Exactly. It's very sensitive to macro news, interest rate fears, anything that spooks the market. This is not a low-risk stock. Investors have to understand they're buying into a high-risk, high-reward proposition.
A risk that definitely needs to be considered after a 284% gain. So let's bring it all together. What's the final thesis here?
The overall outlook is highly bullish. I mean, the sources rate it a 9 out of 10. It's driven by that superior growth and their real, verifiable tech leadership in this critical AI niche.
They aren't just riding the AI wave.
They're building the surfboards.
So whether you're a short-term trader playing those December and February earnings reports, or a long-term investor betting on the future of the data center, this company seems uniquely positioned. Their IP makes them an essential, non-commodity piece of AI infrastructure, and that's what could make this valuation stick.